Well, good afternoon, everyone. Thanks for joining us. My name is Eric Grafstrom. I'm one of the co-founders and CEO at ExitGuide. And we're going to spend a little bit of time today talking about small business valuations, a topic that's, kind of at the core of, what everybody wants to know when it comes to selling their business. I'm joined by Brian Walters, who has, decades of experience in the space of business valuations. Brian serves as both a valuation expert as well as an expert witness in, various cases where there may be some, in divorce proceedings and other cases where they need an expert to come in and talk about business valuations. So we're going to go ahead and get started here. One of the things that we'll do is we'll talk a little bit about, ExitGuide, what you have now, and then we're certainly going to save time for questions at the end. So I'm going to pull up some slides here. I want to point out that there is a Q&A button in Zoom, so you'll want to click on that, submit your questions. Also, my email address is eric@exitguide.com. So if you have questions that you have after this, we'll send out a recorded version to everyone as well, but feel free to email me. Just again, briefly about ExitGuide. We're a little bit different than some of the other, players in this space. What we have found is that, a lot of people will come out and tell you that they can help sell your business. They're going to disintermediate brokers, pay a couple $100, a few $1,000s for a business listing. We believe small business owners, have a variety of needs that start well before they're ready to sell their business. One is to kind of educate you on the process. So, exits mean different things to different people. Some people plan to sell to an employee. Some people plan to find a buyer in their local community. Others don't know what to do. So there's a variety of things that you need to take a look at, and we help educate you, whether it's through webinars such as this or articles or other resources on our platform. Now, I can't overstate the importance of the preparation process. 85% of small business owners do not have any form of documented plan to exit their business. And, this ends up being a big disservice. It's very difficult to sell a business when you're not sure not only what it's worth, but what information you need to present to a buyer. So a lot of deals end up falling apart even before or during the due diligence process. And we provide a lot of tools and resources to help you through that. Eventually, we all hope we get to a point where you're ready to close a transaction. And this is where we can bring in a virtual deal team to help you get that done. So let's start, just a little bit about what you have today. So most of you have gone through what is known as our free assessment. This is a starting point. This is, again, part of the education process to give you a sense of what your business could be worth. Now, you spent a couple minutes on it, so this isn't by any means a formal valuation. This isn't anything that you should take to the bank. This is a starting point, and your dashboard outlines, based on the type of exit you chose through that assessment process, the steps that you're going to need to take. So again, if you're planning to sell to an employee, that's going to look different than if you're planning to sell the assets. And that'll look different than if you were planning to, find a buyer in your local community, which may require you to actually market your business versus starting a little further in the process if you know who that buyer may be. So again, our platform is designed to guide you through the steps that you need to take at a pace that you're comfortable with. And then we can bring in experts such as Brian to answer questions, whether it's related to business valuation, whether it's related to how to present your business to a buyer. It may even be basic legal questions on what type of agreement that you think you'll need. So today we're here to talk about business valuations, which is what everybody wants to know. What's my business worth? So, kind of want to make this a little bit more, interactive with a couple of questions that we have for Brian. But Brian, it'd be great. I mean, you've got all this experience. Why do people even need a business valuation? I mean, isn't this just a matter of just simply, kind of saying, well, I'd like $500,000 or $1 million for my business. Why do we even, need to get a business valuation?
Good afternoon, Eric, and everyone who's joining us online. It's a pleasure to be able to talk to you. Interesting question. You've probably heard the phrase that a business is worth what people want to pay for it. So from that standpoint, the value of a business is not set in stone. And in some ways, it's relatively subjective. But It also is the case that the value of a business can be determined based on the standard of value. By standard of value, I'm going to, without turning this into a valuation class, talk about the most common standard of value, which is referred to as the fair market value. Fair market value essentially means what a business would sell for, given both parties having full knowledge of all relevant facts surrounding the business, and neither party being under any compulsion to conduct the transaction. If those are the parameters, then the fair market value of that business is what both those sides would agree to. And that can look different depending on the situation, but that's why you sort of set that as a framework. But to the extent that a business valuation involves plenty of analysis, you've probably heard the phrase that valuation is part art and part science. My role is to be able to reduce some of the art and have a valuation grounded in as much science as possible. And that's where you talk about, discounted cash flow approaches and the synthesized comparable sales, as you see those on the screenshot. But the idea is to be able to conduct an analysis that results in the conclusion of value that is as close as possible to fair market value.
Is it reasonable to assume that if you're selling to someone, whether it's even someone you know or trying to find a third-party buyer, that having something like this is a necessity?
A necessity would certainly be, my sense would be that it would be a necessity. Now, it can be the case that, let's say, I talked about the standard of value. Let's say if your objective as a seller is not necessarily to arrive at a fair market value, but simply to get a number that you're happy with. And let's say you've had a general manager for your business for the last 20 years, you're looking to retire, you're doing well enough, and you just want a number that doesn't insult you. Then, under those circumstances, you may arrive at a valuation that does not necessarily meet the fair market value standard, but both sides are happy with it. So under those circumstances, it may not be necessary to get a formal valuation. My experience has been that in most circumstances, that scenario just described is the exception rather than the rule. And most of these transactions that involve a buying and a selling scenario, that you'll actually need a valuation to conduct that transaction.
Great. Thanks, Brian. So, for a lot of business owners that we interact with, they've entered some information through the free assessment, but, okay, let's say we want to move into getting something like a valuation report or if necessary, a more formalized valuation. What information are they going to need to gather up?
Primarily, financials would be a really good starting point. Financials, when I say financials, I'm referring to profit and loss statements and balance sheets and cash flow statements and income tax returns. Those four generally represent the starting point for me as a valuation specialist. So as a business owner, if you're looking to sort of, put yourself in the position where you'll be going through this process sometime soon, at minimum, you need to be able to put your hands on all of those items that I just talked about. Some additional items that you'll need, if you have anything along the lines of formal business project or financial projections, those would be very helpful. If there's anything, most businesses, my experience has been, have some sort of an agreement, an operating agreement that in some ways addresses issues relating to evaluation. That's certainly important as well. Those items that I just described would essentially represent the starting point of the information that I'd need. With more information that I'd need as I get into the process, I would be requesting as I come across it.
So I want to talk about a few of your points there, but this gets to a lot of business owners believe starting the business process or the sale process means reaching out to people or telling them about the business. I can't stress enough, getting these financial reports together does a couple of things. One, you're ready to share them, but before you even share them, we really encourage you to make sure that they're accurate and they're up to date and they're thorough. Yep. You can really kind of kill a deal process by sending somebody something that's late, incomplete, has errors, or is missing information. So take the time move through, and again, our dashboard is there. It's free and available to you to actually start to move through these steps and make sure that what you have is exactly what the buyer is both expecting and you something that you can deliver. Now, Brian, I want to ask you a little bit about something you and I have talked about before, which is, you kind of mentioned art and science. We get questions a lot about goodwill, and people say, well, what does that mean, and how does that apply to my business? Can you talk a little bit more about that and how that applies?
Kind of hard to talk about it without turning this into a valuation class. So let's just do maybe an undergraduate level valuation class. Most businesses have two types of value. The overall value I refer to as a fair market value is, let's say that value is $1.2 million, right? For most businesses, there's also tangible value. Tangible value meaning if you look at the balance sheet and see that there are assets and liabilities on the balance sheet. If you subtract the value of the subtract the value of the liabilities from the value of the assets, in my loose example here, let's say there's 400,000 in assets, 200,000 in liabilities. That gives you a net asset value, a net tangible asset value of 200,000. With a business that is worth 1.2 million, that means that the value of goodwill is $1 million, if that makes sense. It further has to be understood that goodwill is separated into two different types. One is referred to as personal goodwill, which is generally the goodwill that attaches to the specific business owners of the business. And then enterprise goodwill would be the value or the goodwill that attaches to the business. Brief example. Let's say you have two businesses, both valued at $1 million. One is a coffee shop and the other is a massage therapy studio. You can have the exact same valuation, $1 million, but the coffee shop, most people are going to go to that coffee shop because it's conveniently located, because they like the service, they like the employees. You can get in and out quickly. Those things have nothing necessarily to do with the specific owner. So that would be an example of a business that is high in enterprise goodwill, low in personal goodwill. For the massage therapy studio, and for my example, let's just say it's you are the owner and you're the one who performs the service. It is very likely that the reason that you use that business is because of the specific owner, the specific massage therapist. And so that would be an example of a business that is high in personal goodwill. One, again, same valuation. The first example, high enterprise goodwill. The second example, high personal goodwill. It becomes extremely important in the context of selling a business to understand what the value of personal goodwill is. The reason for that is if you are, in my example, I just talked about the massage therapist, unless you are going to stay on board after you sell the business and become an employee, your value leaves with you after the transaction. So if I calculate your personal goodwill to be $600,000 on $1 million company, you will not be able to sell it for 600,000. I'm sorry, you won't be able to sell it for 1 million. You'll be able to only sell it for 400,000 because that personal goodwill stays with the owner. That's sort of the concept. And again, it becomes extremely important to understand that in the context of somebody who's looking to sell their business, because operationally, as you go through and manage the affairs of your business, as a business owner, you should be always looking to ways of establishing practices and methods of operating your business that allow you as the owner to be separated from the business. So if you're thinking, for example, in terms of, I'm looking to sell my business next year, the question that you have to ask yourself before anything else is, can this business survive without me? If it cannot survive without you, then that's an indication that your personal goodwill is relatively high and the value of that business would be reduced by the amount of personal goodwill.
Okay. So that kind of gets into, a lot of what we hear, and someone who is, thinking ahead and they're planning to sell their business, and maybe they've gone through and they've looked at their free assessment. They've said, okay, my business is worth about this much. I don't have to sell now. I may want to sell, maybe 1, 2, 3 years from now. What are some just very kind of practical things that they can do to measure, maybe milestones or set goals from themselves to increase the value of their business?
I'll answer that two different ways. Number one, understand the drivers of the value of your business. For example, if you are, just to use a loose example, let's say your business was determined to be $1 million in value. But understanding the detail behind the valuation report, you see that much of it is determined from the analysis of your income, and your income is determined by obviously revenues minus expenses. If there is an opportunity to go through line item by line item through your financials and figure out a way to reduce your expenses, that means a greater net income that automatically translates to a larger value, all else being equal. And then I'll go back to what I said a second ago. Understand that the value of your business can sometimes be something different from what you can expect to get for it in a transaction as it relates to personal goodwill considerations. So go through all of the operations of your business and try to understand all of the different ways that you as the owner become the answer for every question that is asked in your business. And as a business owner, it can be very much an ego boost to know that I'm the one who the answers have to go through. But if you're looking to sell your business, that actually works against you. So understand the different ways that you can automate some of your processes, empower some of your subordinates, and do different things such that you can get to the point where your business can operate seamlessly without your direct involvement. To the extent that you can be sort of, an overseer of the business, maybe in some ways the face of the business, maybe generating income, pounding the pavement to get revenue, but the operational aspects of your business all have to be in such a way that it can operate without your direct influence. And generally that impacts the amount of personal goodwill. And again, all else being equal, a lower personal goodwill increases the amount that you can get for your business.
Yeah. And I think one of the ways that I've heard it explained to people, is, are you the business, right? And to your point with the massage therapist, sometimes we see this with other types of professional services. If someone who has been coming to you, they want your services, they want your expertise. So, what I want to do is kind of frame some of the things that, Brian, you and I have talked about, which is, we've got this free valuation tool on our website, which is kind of a starting point to help you get educated and give you a sense of where you are. A valuation report is more about what we've got here, which is, how do you think about setting a sale price? And, if you're going to go look for a loan for an SBA lender or for something that is, a lot more detailed, you may need a more formal report. But let's talk about, some of the factors that go in, that if someone kind of says, okay, I want to get a valuation report, I'm trying to figure out what I should ask for my business. What are the things that they should be thinking about?
In terms of what number to ask for, in terms of it's never a bad idea to sort of start at a high level. You mentioned the tool that's available on the website, and that does allow for a business owner to get a sense of what their business might be worth. If you're going to have more formal or serious discussions other than that, then very honestly, it would make more sense to do a proper valuation, because the reality is that most people who are not in the business valuation space don't have necessarily an intuitive idea of what their business might be worth. And there are some sort of rule of thumb type valuations that you can do. You've heard people say 1x revenue or 3x net income that, are as good for sort of what they refer to as back of the napkin calculations. And if you just wanted to get an idea of what the business might be worth, it may serve that purpose. But anything more serious than that, anything more formal than that, anything that you're looking to attach significance to and attach a strategy for leaving your business, then it would make sense to have a more formal analysis done.
Okay. And we're going to move to Q&A here in just a moment. One of the things that, again, if you have questions, click on the Q&A button, in the bottom, and we'll field those questions. But one of the things that we hear is kind of setting your expectations, relative to what you think the business is worth versus what someone would pay. So having that kind of third party, whether it's, one of the reports that we deliver, whether it's something with, a valuation tool, it's good to have some objective perspective and data to back up that asking price. And even if you're not trying to optimize for the top price, you may be simply trying to kind of do something that's fair to an employee, to a business partner, or maybe somebody in your community that you know. So, just having something is better than nothing, and it gives both sides, a bit of comfort.
And in fact, if you don't mind me expanding on that just a second, based on a real life example, I recently had a client who, again, I want to qualify that I'm not a broker, and in no way am I ever involved with the sale of a business. But I had a client who did not want to do a formal valuation and simply said, I know the seller of the business, they know me, and we just want a number that will not insult both of us. And so if you were, for example, to be able to establish a range of values, then I'd like to be able to start the conversation with that range. Under those circumstances, it may be that the tool that is on your website is perfectly fine. And again, under the circumstances where you're not necessarily looking to establish specific fair market value, but just to understand based on an analysis of, sold businesses similar to the subject business that have sold recently, what might that imply in terms of what the value could be? That tool may just be well enough to start the conversation, and then, take it from there and conduct the transaction. Under those circumstances, that would be perfectly fine. The opposite end of that spectrum would be if you need something more formal, and then that's when it would be required, or at least recommended, that you get a more formal valuation.
Okay, there's we've got a few minutes before we're going to wrap up. A couple of questions that have come in here. One is, can you give a very simplified version of what is meant by a multiple?
A multiple, okay. You can conduct a search under, and there's a couple of different databases that I have available to me. And that search can give me actual transactions of companies similar to the subject company that have sold. For each of those, for every company, you have certain metrics. You have revenue, you have gross profit, you have EBITDA, which is earnings before interest, taxes, depreciation, and amortization. You have EBIT, and you have discretionary earnings. You can calculate based on the transactions that have been conducted in the past. You can actually go through, see what each of them sold for, and then divide that selling price, or divide the metric that we're talking about by the selling price. So for example, if you go through and you realize that the average company in your data set that you've looked at sold for $400,000, and the average company is $1 million in revenues, then that tells you that the sales multiple is 0.4. Then you'd simply take 0.4, multiply it by your revenue, and then that gives you an idea of what the business would sell for in terms of what, comparing it to sales of previous businesses. And again, you can do the same thing for all of the other multiples. Look at the gross profit, the average gross profit in your data set, divide that by the sales price, calculate the gross multiple, and then apply it to your business to see what that would look like. Essentially, a long way of summarizing it is just simply looking at each of those metrics as compared to what the selling price was, and then making inferences on that based on that information.
Okay, and there's two questions here that are somewhat related, so I'm going to combine them. Is there anything to do with seasonality, time of year, or how much do valuations change over time? So I guess if someone's looking and saying, well, look, I'm not in a rush to do this, but I do want to do this maybe in the next 12 to 24 months. Does it make a difference trying to do it in the fall, or is it possible that valuations could really see a dramatic increase or decrease over something that is as short as 12 to 18 months?
That's a good question. I'll answer it this way. If there is an established business, let's say you've been tooling along for the last 10 years and you have a pretty established business, it is unlikely that doing a valuation in the fall versus the spring is going to make that much of a difference. So if the question about seasonality is what that refers to, that would be my answer there. But if you're looking at, for example, a valuation in November of 2023 versus a valuation in November of 2024, then there are a lot of things that can change over the course of that time that will impact the value of the business. For example, the cost of capital is going to be different. Interest rates go up and down, and you use those to help with the calculations and some of the valuation methodologies that you use. So you want to make sure that that's relatively consistent. Another thing that could happen is that if you have done as I suggested earlier, and you've gone through and made sure that each of your line items and your expenses have been optimized so much to be able to provide the best amount of net income for you, then you have to give your company enough time to be able to implement those changes, such that if you do valuation today versus a year from now with more optimized financials would result in a higher valuation, all else being equal. So the long or the short version to that answer would be, doing it in the summer versus spring doesn't make a whole lot of difference. But over time, if there's either anything that changes in the overall environment, such as the cost of capital or anything related to the economy, or anything related to your operations that would have made a big difference, that can be something that can be can make the difference in that analysis.
Okay, and I'm gonna pull a broadcast question here, which is we've got if you can do this in a minute or less, because we're running out of time. But if the business has a partner or a customer that accounts for, say, more than 50% of their revenue, how should they think about that as it relates to the valuation? Should they wait and maybe see if they can expand more contracts? Does that hurt them? Does that help them? I mean, how do you look at something like that when you're doing an evaluation?
So answering that question in 35 seconds is not easy, but I would say
give you 40.
That represents a tremendous risk, because essentially, as a valuation specialist, I have to look at both scenarios. Number one, with that customer staying, and then number two, with the customer not being there. And I have to accommodate for that. Maybe I add a larger element of risk, which all else being equal lowers the valuation. But there's several different tools that I have as a valuation specialist that I will not have time to go into in this call. Happy to follow up with you who asked that question later on. If you can share my email address, and we'll have that conversation. But definitely that's something that will impact the analysis.
Okay. So look, yeah, I want to kind of just, toward the tail end here, talk about the ways that we do help. There's subscription-based services. So what you have access to today is in your dashboard, and that's what we refer to as your Kickstart exit. These are all the tools you need to kind of, prepare. And what we tell people is, look, one of the ways that we like to help, small business owners is so that you're prepared with the information and questions that you need to engage a professional like Brian. If your business is worth tens of millions of dollars, then maybe you can afford to have, Brian or one of the other coaches that we have access to through our network to kind of, do some of this, hey, if you can get me this information and, compile these documents. But what we want to do is want to save you, some time and be efficient with your dollars by getting prepared for these conversations. A jumpstart exit, is really for someone who's just saying, look, I don't even know where I am today. Like, I just need to go from, thinking I need to do some things to being ready to actually, market my business or engage my potential buyer, that employee that maybe wanted to buy the business. And then when you're ready to move through a transaction, this is where you'll have access to resources, whether it's one of our coaches, it's like Brian to help with valuation, attorneys who can help you in terms of reviewing deal terms and crafting the right agreement for you. So you have a variety of things that will allow you to move through your transaction efficiently. We've talked a little bit about a valuation report. We also offer sell sheets. So these are more a la carte type services when you're early in the process. A coaching session. So if you have a couple of questions and you want to really talk through your specific situation, you can book a session with someone like myself or with Brian or one of the other people who will walk you through everything from due diligence to valuations to contractual pieces. So These are one-off sessions that deliver a tremendous amount of value. A sell sheet, most people will say, okay, well, now what do I do if I have somebody who's expressed interest? What do I send them? What's too much information? What's too little information? How do I look like I'm doing this professionally? And that's what a sell sheet will offer. A valuation report, and again, it's not a full-on formal business valuation. While that can be offered, this is a way that you can do something that at least has some level of documentation robust. And this is when you're really kind of trying to close a deal. You're not necessarily trying to grind away and get the exact number, or have a more I would say involved negotiation. This often plays in when you're trying to sell to an employee or a family member, business, someone that and you're trying to get a fair price. So those are some of the things that we offer. We've helped a variety of business owners, whether it's somebody who's trying to sell to a competitor in their local community, asset purchase agreements to somebody who's sold to an employee. So there is no one exit for everyone. Each situation is a little bit different. So we want to give you the tools and access to the resources to help you with that. We're going to close up today. We'll have another webinar on December 5th. We're going to bring in Patrick McMillan, who's a fractional CFO and has performed due diligence and quality of earnings for a variety of clients. And this is one of the most important things that I mentioned at the top of this webinar. 50% or more of deals fall apart during the due diligence process, and a lot of that has to do with lack of proper preparation. So if you want to learn a little bit more about how you can enter that due diligence process, ready to go and feeling confident that you have the information, it's accurate and everything that a buyer will expect, then you're going to go ahead and increase the chances of actually closing a deal. Lastly, if you have questions, if you want to follow up, there is, we've got a question coming in here from one of our viewers. Alan, if you want to go ahead and drop an email to me, eric@exitguide.com, we're here to help. So Brian, thanks so much for going. If you guys don't know, Brian is one of my favorite people here in Austin. He's also very involved with cricket here in the US, which is in and of itself worth probably scheduling a coaching session with him just to learn more about that. But if we didn't get to one of your questions or you want something more detailed, please feel free to reach out to me by email. Look for us on December 5th. There'll be another one, and then we'll continue to hold these on a monthly basis going into 2024. So Brian, thanks again. Thanks everyone who attended, and have a great holiday.
My pleasure. See you all soon.